With inflation on the rise and interest rates expected to go up in the coming months, it could be the perfect time to hedge your investments and invest in some really smart dividend stocks. Dividends can be a really tax-efficient way to invest with tax relief on dividends, as well as providing that reliable growth your portfolio needs. It's also going to provide a really nice shield against inflation, which is currently on the rise. Today, I'm going to be looking at top dividend stocks to buy now, and I'm going to focus on those that provide growth as well as that growth in dividend, because we want that growth in the stock price and within the dividend. So we're looking for those magic shares, which are going to give us that nice growth as well as a nice stable dividend. And these companies are all ones that have been paying a dividend for a really long time. Because when you're looking for dividends, you really want reliability, so we can get reliable returns on our initial investment. If you want to see more of these stock recommendations, please let me know by smashing that like button. And if you're new here, do consider subscribing, because I'll be showing you in the upcoming videos exactly what I'm buying and what I'm holding in my portfolio. Now, with that being said, let's dive straight into stock number one. So for each of these, I'm going to give you the core fundamentals in an easy format and then run through each share and why I recommend it. So the first stock on my list is Chevron with the ticker symbol CVX. Now, Chevron Corporation is an American multinational energy corporation. It's the second largest oil company in America, and it's one of the successors of Standard Oil, and it was founded in 1879. Now, of course, when it comes to oil, the market trend is obviously downwards. People are investing in electric, and electric is the future, and it is dependent on oil prices. In fact, Chevron is actually the last remaining company in the Dow, but what you need to remember here, although the shift is towards electric, it's going to take a long time to get there. So it's not going to be an instant transition, it's going to take many, many years. And even if it did decline, these companies aren't stupid, they're going to be transitioning into this new technology. The earnings are forecast to grow 6.54% per year. It's set to be posting its biggest earnings in 13 years, with the average European gas price almost doubling quarter on quarter, while in the US, Henry Hub has jumped 45%. This company has increased its dividend annually for 34 years, with 4.66% dividend yield, which indicates that returning profit to shareholders is a top priority for the company. Now, if we take a look at the technical analysis for Chevron, the price of the share currently is $114. It's got a target upside of $125, which is a 9.97% upside. The dividend yield is 4.66%, and the dividend amount is 5.36. The market cap is currently $221 billion, which shows it's a huge company. The PE ratio is 60, which for this type of company is possibly a little bit high, but it's still relatively low compared to some of your normal tech stocks. It's in the utility sector, and if we take a look what the analysts are saying, we can see their consensus is a moderate buy. The new sentiment is neutral, investor sentiment is very positive, media buzz is medium, and hedge fund signal is also neutral. And the top target is $121 with a smart score of 9. And if we take a look at the price forecast, we can see the target price is $125, which shows the average from all of the indications. So down below here, you can see I've got the different analyst forecasts from all the different companies. We've got JP Morgan, Bank of America, Citigroup. And if we take a look, we've got different predictions for all of them, and we're getting an average of $125. So from the current price of $114, that would be a really nice increase. On the high side, we're looking at $150, but on the low side, we're looking at $105. But the average consensus is it will be $125. So the smart score on this one is 8, and it's set to outperform. It's a moderate buy, bullish sentiment with an increased trend. The investor sentiment is very negative, but I wouldn't read into that too much because all of the other figures are looking so good. The new sentiment is neutral, and the technicals are very positive. And if we take a look at the earnings, you can see in 2020 it did have a bad quarter 2. Of a quarter 3 that's coming shortly, it's expected to have really nice earnings. So with that one, I think it could be a really nice buy if you're looking to add some within the oil sector. The next one on my list, which I'm sure you're all going to be really familiar with, is Johnson & Johnson. So for those of you who might not know, Johnson & Johnson owns a portfolio of excellent brands that make products people need, specifically healthcare items. Brands like Band-Aid, Benadryl, Listerine, and all of the Johnson's brands. J&J reported quarterly revenues of $23.3 billion, up 10.7% from the previous year's figures of $21 billion, driven primarily by the 13.8% year-over-year rise in sales witnessed in the pharma sector. The really cool thing as well with Johnson & Johnson, they've got a new COVID vaccine which is administered in just 1 dose, and traditional ones are done in 2 doses, which is a huge win for the company. And they've been authorised for emergency use. So that could massively help their sales in the coming months. It's had a whopping 58 years of dividend growth, and it's got a forward dividend yield of 2.56%. So the current share price of Johnson & Johnson is $164, with a price target upside of $196. That's a 19.25% upside, which is one of the highest on our list. The dividend yield is lower at 2.56%, and the dividend amount is 4.24. It's got a market cap of 432 billion with a PE ratio nice and low at 24. And that's had a yearly gain of 16.63%. And the consensus on this one is a strong buy. The news is very bullish, the investor sentiment is very negative, which is a surprise. The media buzz is high and hedge fund signals are very positive, with a top analyst price of $191 with a smart score of 10. So with J&J, the current price is $164. We can see the high side, it's $215. On the low side, $178, with the average coming in at $196. So even the low estimates are actually above the current price, which makes this one a really attractive buy. So this one's got a smart score of 10 and it's set to outperform. The consensus is it's a strong buy. The sentiment is bullish, it's got an increased trend in hedge fund activity. The sentiment again is negative, but I wouldn't again worry about that too much. The new sentiment is bullish, but the technicals are set to negative, which again is quite surprising given everything else is looking quite positive. Looking at the financials, you can see that earnings have been really steady across the board. And that's because it's a really huge company that everybody's using in everyday life. Now, although for this one the technicals were negative, you can just see here all of the analysts are actually saying buy or hold. And they're all giving really good estimates and upside in the price prediction. Now, I know I'm going to get asked a question and you're wondering what is this software I'm using, and this is actually TipRanks, which I think is fantastic for analysing stocks. I use this one for all US shares that I'm analysing, and it gives me a really good picture of what to buy, what to hold and what to sell. And if you guys want to check it out, I will leave a link down below in the description. The next one on my list is Federal Realty, and that's got the ticker symbol FRT. Now, Federal Realty Investment Trust is a real estate investment trust, or a REIT, that invests in shopping centres in the northeast of the United States, the mid-Atlantic states, California and South Florida. It's recorded a record leasing volume, more than the company has ever done in its 50-year history. Earnings per share is up 83% year on year, exceeding even the most optimistic forecasts by 20 cents a share. And it's had a fantastic 54 years of dividend growth, with a forward dividend yield of 2.56%. Now, the current share price is $121 per share. The target upside is $129, slightly low, and it actually makes it the lowest on our list for upside, but the dividend yield is 3.52%. The dividend amount is $4.28. The market cap is lower and is the lowest on our list at $9.46 billion, which is still a massive amount of money. The PE ratio is 61. The yearly gain has been a whopping 71%, which is what makes this one so attractive, which also shows how powerful these can be. Just imagine getting that yearly gain on top of the dividend. The sentiment for this one is it's a strong buy. The news is neutral, investor sentiment very positive. Media buzz is quite low. Now, not an awful lot of people talk about these REITs like they do other stocks and shares, and that's why it is very low. The hedge fund signals, though, are very positive, with a top prediction coming in at $134. So this one is classed as a moderate buy. The current price is coming in at $121. Now, the estimates are quite steady on this one. On the high side, we've got $140, average is $129, and the low side is even $122. Now, I do like these shares where even the low one is higher than the current price, because that is a really good indication. Not one of the analysts are indicating this share as a sell. The smart score for this one is 10, and these are some of the most attractive ones I've seen so far. The consensus is it's a moderate buy, sentiment is bullish, the trend is increased, the sentiment on the investors is very positive, and the last 7 days the news has been very bullish. And the technicals are all positive with a 64% momentum. And if we look at the price chart, you can just see how much the price has increased over the past 12 months as things have recovered. There was a bit of a blip in Q3 2020, but since then they have kind of been back on track. And as I mentioned, they're expected to release some record earnings in this quarter. So if you're looking to add a REIT to your portfolio, this one could be a really nice option. Now, the fourth one on my list, which could be one of my favorites, is the Altria Group with the ticker symbol MO. Now, this one might be a little bit of a controversial one depending on your ethics, but it's one of the world's largest producers and marketers of tobacco, smokeless products and wine, and it was founded in 1985. They've managed to stay ahead of the competition by aiming to move beyond smoking to harm reduction. But of course, smoking does still make up a large portion of their revenue. It posted revenues of $6.9 billion, an 8.9% increase year on year. Its oral tobacco grew in revenue by 5%, and its wine division grew an impressive 27.5%. It's had a whopping 51 years of dividend dividend growth, and it's got a forward dividend yield of 7.48%, which is huge. So looking at the stats for this one, the current price is $48, the target upside is 52.83, which is a 9.72% upside, but its dividend yield is so attractive at 7.21%. The dividend amount is $3.60, with a market cap of $88 billion. The PE ratio is nice and low at 19.6, and it's had a yearly gain of 34%. Now the consensus on this one is a moderate buy, the news sentiment is neutral, investor sentiment is very positive, the media buzz is medium, it's not very entertaining to talk about tobacco stocks, and the hedge fund signal is very positive, with a top price coming in at $54. So this one is coming in at a strong buy with a rating of 7. The current price is $48, and if we take a look at the targets, we can see on the high side it's $57, the low is $45 with an average of $52. And all of the analysts are currently giving this a buy or a hold rating. If we take a look at the signals, the smart score is 10, the consensus is a strong buy, the sentiment is bullish, the hedge fund activity is decreased with this one, the sentiment is very positive, the news sentiment is neutral, but the technicals are very positive. And the earnings for this one have been very steady. Now this one for me is really tricky because of course I don't really want to be supporting tobacco sales because it's not good for your health, but I do think this is probably one of the strongest dividend companies on the market. And it's true that a lot of tobacco companies do have a really great dividend. I think out of all of the tobacco companies, this is probably the one that's going to kind of weather the storm and transition the company into something much more positive, which is either smokeless products or focusing on things like wine. And like the oil company, it's going to take an awful long time for people to give up smoking altogether. Now last but by no means least on my list is Stanley Black & Decker, or the ticker symbol SWK. Now if you didn't already know, Black & Decker is a Fortune 500 American manufacturer of industrial tools and household hardware and provider of security products. And you're going to see them all over the place at pretty much any hardware store. Now the stock price has only increased 6% over the last 12 months, but again that would still be great on top of your dividends. But what's really attractive about this is it's currently trading around 16% below its 52-week high. Now at the same time, the PE multiple has declined from 29 times to a 17x, a decline of 41% year on year. Currently, based on the 10-year PE ratio multiple, SWK is trading at the lower end of its PE multiple, making it a really good value buy. The company's had a solid 54 years of dividend growth and a forward dividend yield of 1.58%. The current price is $189 with a target upside of $227 with a massive 20% upside. Now a lot of this upside does come a lot with people being at home and spending more money on hardware products. And as well, the average American home is 37 years old, so the next generation is going to need to spend an awful lot of money on home repairs. The dividend yield is lower at 1.58%, and the dividend amount is $3.16. The market cap is huge at $30 billion, and the PE ratio is the lowest on our list at 16.9, and it's had a yearly gain of 10.45%. Now the analyst consensus for this one is a strong buy, the news is very bullish, the investor is very positive, the media buzz is medium, again not the most interesting, and the hedge fund signal is very positive, with the top analyst predictions coming in at $227, with a 20% upside, which is the biggest on our list. Now this is where this one is really attractive. The current price is $188. The high side is $259, the average is $227, and even on the low side it's $201. The smart score for this one is 9, it's got a strong buy as a consensus, the sentiment is bullish, it's got increased hedge fund activity, but this is quite interesting, the sentiment is very negative, the news is bullish, and the technicals are negative. So if we take a look at the chart, you can see why from its highs over here at $208, $216, it has been on the way down, right down to $173. But it is already up to 188 and it is back on the rise. The financials for this one are really good. You can see how it's been increasing, and you can take a look at the revenues. You can see it's been growing revenues, but you can also see it's increased its earnings year on year. So what's interesting with this one, the dividend isn't as high, but actually the potential in the stock, it's really a good buy just as a stock pick. And you can think of the dividend just as a bonus. So if I had to put these in some kind of order and rate them, this is how I would class them. So in 5th place, I would put Chevron, which is a utilities company. It's got a 10.42% upside and it's got a 4.6% dividend. In 4th place, I would put Federal Realty or FRT, which is a financial company with its 7% upside and its 3.42% dividend yield. In 3rd place, I put Johnson & Johnson, J&J, which is a healthcare company. It's got a whopping 19.45% upside, but it's got a relatively low 2.56% dividend. In second place, I'm going to put Stanley Black & Decker SWK, which is consumer goods, with its 20.42% upside and a 1.58% dividend yield. Now in first place, I would actually put the controversial one, which is Altria Group. It's got a 10.18% upside with a whopping 7.21% dividend yield. And I'd put that one at the top because I think it's a forward-thinking company, it's growing well, and it's definitely trying to adapt for the future. Obviously with this, it depends what your goal is. If you're going more towards dividends, you could pick up Johnson & Johnson and Stanley Black & Decker just as stock plays and take the dividend as just a bonus. All of these options are really safe buys, and the dividend is pretty much going nowhere because they've all increased it for a ridiculous amount of years. If you've got any other dividend companies, let me know down below which one's your favourite and which ones you're holding. And if you found this useful, do me a favour and just hit that like button because it really helps. So thank you guys so much for watching. I'll update you soon on which ones I'm holding. If you missed my last portfolio update, I will leave it right here. And as always guys, build those dividends and let's make those gains. Thanks.